Well, there's a look at the U.S. futures picture right now. It's a little bit mixed. It feels like so far this year, investors are going back and forth on interest rate policy. At least in the short term, we had some new consumer inflation numbers released yesterday in the U.S. They were hotter than expected. That suggested the American Central Bank, the Federal Reserve, might not be compelled to cut interest rates as soon as its March meeting. And the head of the Cleveland Fed poured some cold water on that idea as well. This morning, though, we got some producer prices in the U.S., which in the eyes of some, boost bets on Fed rate cuts. Now, Canada has its own interest rate decision in a couple of weeks' time. Certainly, the odds of rate cuts have climbed over the last few months, although there is no cut currently expected at the upcoming January meeting. For more on how investors should think about rates this year and what that means for the markets, we're joined by Earl Davis. He is head of fixed income and money markets at BMO Global Asset Management. Nice to see you.
A pleasure seeing you as well.
Our favorite topic. Okay, we got two new data points in the U.S. over the last 2 days. How does it impact your view on interest rate policy in the U.S. this year?
Yeah, it reinforces our view that, you know what, we do think there's a change. Our base case is for cuts this year, not just as early as the market anticipates. So, for example, in the U.S., and Canada's not too far behind, it's 100% of cuts being discounted for April. We think there's a high likelihood that first cut is more like September. And part of the reason why is we're still seeing a slowing economy, but it's still resilient, still positive, employment's still tight. And we saw the surprise to the upside inflation of yesterday, which wasn't a surprise to us, and we expect the next 2 months to be upside surprises as well. And part of that reason is what they call base effects. Last year at this time, inflation was very low for the first 3 months of the year. So just a comparison to the year before, just mechanically, we expect higher than what the market's expecting right now.
Is there always that possibility? I mean, we were literally just talking about a big U.S. bank committing to 20,000 job cuts. Is there always that possibility if things start to cool down faster than maybe some would think that the timing on rate cuts would change?
Totally. That's why this year, when we look at the economic data releases, inflation is not our first thing we're looking at. The employment number is.
Okay.
That's going to give you the indicator of the timing of cuts. So that's a very important one. The second thing that we're looking at ahead of inflation, CPI, is actually ECI in the U.S., Employment Cost Index. It's a quarterly release that comes out Jan 31. Mark that day on your calendar.
Okay.
That is the most inclusive and robust picture of wage inflation in the U.S. It's looked at very closely by central bankers. That will have an impact on the timing as well. So employment's extremely important, both Canada and U.S., those numbers. And we think the unemployment rate has to go up by basically 0.5 percentage points from present levels. So 4.5 in the U.S., 6.5 in Canada, before the central banks really start easing.
It's been interesting because the inflationary reality was you saw a lot of workers in different industries that were lobbying for higher wages. Yes. So you have that demand, and then I guess you sort of balance that out with what the companies ultimately decide they need in terms of workforces if the economy cools. We'll watch that all play out. I did just want to clarify when it comes to the U.S., right now, it seems like the market generally, regardless of the timing on rate cuts, thinks that you'll see sort of a steady decline in rates, like, you know, a 1/4 point decline, nothing sort of dramatic at any one meeting. Is that how you would think about it too, or same unknown?
Well, this is why I smile. So if we look at 2024, we think there's, let's call it a 75% chance of rate eases, declines in interest rates. We think there's a 15% chance that nothing happens to interest rates. Okay. And we think there's a 10% chance there's still a hike on the table. So it's a very
why not?
Yeah. So it's a very interesting year this year, you know. Okay.
So you mentioned the employment picture, and in the most recent Canadian jobs data, and obviously the monthly numbers, you know, can whatever, but the soft. So if you had to compare the state of affairs in the U.S. versus the state of affairs economically in Canada, what would be your summation there?
Yeah, Canada's definitely behind the U.S. I think it's a sort of, and we see it in the growth numbers for 2023. Having said that, the resiliency of where the growth, we were close to a recession in Canada, 0, slightly negative on our month-on-month GDPs, while we were very positive, actually surprised to the high side GDP growth in the U.S. A lot of that's driven by fiscal deficits. The fiscal deficit in the U.S. is 3 times higher than it is in Canada, which is supportive of the economy. So because of that, we think Canada will also benefit from it this year. That's why we're saying there's an actual growth surprise in Canada is our feel.
If the U.S. does okay,
Yes.
that bleeds into Canada, basically.
100%. And we've seen that. It's less than it has been historically, but still significant, right? You know, the old saying, U.S. sneezes and Canada catches a cold.
Yeah.
It works both ways.
So then for the timing, let's say, because the Bank of Canada has to do their own messaging,
Yep.
if they were to commit to a rate cut, time of year you would expect that to happen?
I think it's more September-ish, and the reason why is that even though the last employment number in Canada was, you know, weak, part-time, full-time mix, the wage was a surprise higher. Wage growth was 0.7 higher, 5.7 versus 5 expected. That is massive, and that's something that the Governor Macklem is looking at closely.
Okay, so this is all really helpful stuff. In terms of investment decisions, though, you know, I think one of the things that we've seen in the bond market is that these higher yields, you know, these are things that aren't always available to investors. So you have seen some opportunity in the bond market. Is that fair to say?
Yeah, lots of opportunity. You know, all in all, we're constructive of the economy, constructive duration, constructive of credit and yield. First time since 2021 we've been constructive. You know, we've been on the bearish side for the past 2 years. And what that means is, I like it, and I can't take full credit for this, Scott, it's the year of the yield.
Okay.
You know, you're looking to get yield. Duration, you could be neutral to slightly long, depending on where we are, but it's the year of the yield.
And you could get some of that from government bonds, but you can also get that by buying, you know, let's say a Canadian well-known steady Eddie corporation that has bonds in the marketplace.
A bank. Yeah. The financials, the yield you're getting on them is very attractive for the business models. And the reason why the yields are so attractive is because they need to finance buying other banks. Last year, you know what? BMO bought Bank of the South. You have to finance that. This year, you have RBC with HSBC.
Right.
They have to issue bonds. That keeps the supply, that keeps the yields higher. These are solid businesses, looks very attractive. And the other ones, telecoms, you see they have the ability to pass through inflation, if not more than inflation. These are great businesses with great yields.
Yeah, I remember